Everybody wants the deal, but not everybody can afford the deal. So what happens when the numbers work, but your balance sheet doesn't? This is the moment that separates the investors who scale from the ones who stall. And it's happening right now in markets from Dallas to Detroit. Interest rates climbed from near zero to over 7% in less than 2 years. And that single shift turned a lot of solo plays into impossible math overnight. What used to pencil with one signature now requires either a miracle lender or a second name on the dotted line. Think of your credit like a tank of gas. You can drive it hard. But the moment you're running on fumes in the middle of nowhere, you're not being bold, you're being stranded. Stretching your debt-to-income ratio to its absolute ceiling is the financial equivalent of flooring it with the low fuel light on. Just a few years ago, headlines were screaming about house hackers and Burr millionaires turning $50,000 into empires. And those stories were real, but they were also writing a uniquely forgiving rate environment that no longer exists. The enthusiasm hasn't fully died, but the spreadsheets have sobered up considerably. Even seasoned investors are second-guessing their conviction right now, and that psychological friction is actually healthy data. Robert Kiyosaki talks about using other people's money, but what he doesn't always mention is that the partnership structure matters just as much as the deal itself. Real estate moves in cycles that rhyme almost perfectly every 15 to 20 years. The overextension, the correction, the consolidation, the comeback. And we are currently somewhere in that uncomfortable middle chapter. History doesn't repeat, but as Mark Twain probably didn't actually say, it does rhyme with an almost annoying consistency. In the 1980s, interest rate pain forced a generation of investors into creative financing arrangements that actually built some of the most durable real estate portfolios in American history. The lesson isn't that pain is good, it's that constraint forces creativity, and creativity often beats capital. A lot of people hear partnership and immediately imagine drama, disagreements, and a courtroom somewhere down the road, but that's the exception, not the rule. When agreements are structured properly from day one, the misconception that going solo is safer ignores the very real risk of over-leveraging your personal credit into a single deal that goes sideways. Here's the practical framework. If taking on one more property would push your debt to income above 43%, require you to drain your reserves below 3 months of expenses, or lock you out of better opportunities for the next 18 months, that is the exact moment to pick up the phone. A partner with capital and a clear operating agreement is not a compromise, it's a sophisticated capital allocation strategy. The best investors we've ever studied weren't the ones with the highest conviction, they were the ones with the most disciplined position sizing, and the humility to share the upside rather than hoard it. 50% of a cash-flowing duplex beats 100% of a deal you had to sell in year one because the pressure got unbearable. At the philosophical core, real estate wealth is rarely about the single bold move. It's about surviving long enough to make the next move and the one after that. The investor still in the game in year 10 almost always outperforms the one who swung for the fences in year one. And here's the quiet irony nobody talks about. The people most convinced they don't need partners are often the most undercapitalized and the most exposed. Meanwhile, the people with the most resources are also the ones most aggressively seeking co-investment because they understand that diversification compounds returns and reduces catastrophic risk simultaneously. So the smarter question isn't whether you can technically close this deal alone, it's whether doing so positions you to close the next three. Discipline, sizing, and consistency are the actual strategy. Everything else is just narrative. Whatever the market does next, another rate spike, a soft landing, or something nobody predicted, the investors who built flexible, partnership-friendly structures will have options. And options are the most underrated asset class in real estate. Being comfortable with any outcome isn't weakness, it's the highest form of preparation. And if you're trying to figure out where you fall on this spectrum, whether you should stretch, partner, or simply wait, we can help you get started in real estate investing, connect you with home contracting work, and point you toward the right lenders. So check out our links in the description below.